This LOS is explain risks in relying on ratings from credit rating agencies. Risks in relying on credit ratings. There are risks in relying too much on credit agency ratings. 1. Creditworthiness may change over time, and initial current ratings do not necessarily reflect the creditworthiness of an issue or bond over an investor's holding period. 2. Valuations often adjust before ratings change, and the notching process may not adequately reflect the price decline of a bond that is lower ranked in the capital structure. 3. Because ratings primarily reflect the probability of default, but not necessarily the severity of loss given default, bonds with the same rating may have significantly different expected losses, default probability times loss severity. And finally, 4, like analysts, credit rating agencies may have difficulty forecasting certain credit negative outcomes, such as adverse litigation, leveraging corporate transactions, and such low probability, high severity events as earthquakes and hurricanes. So a quick little summary here. Credit rating may change, downgrade, upgrade. Credit ratings tend to lag market pricing. Rating agencies make mistakes, subprime mortgages. As an example, we can look at what happened with the Lehman Brothers. Issuer-specific risks may be unpredictable, litigation, natural disasters, leveraged buyouts. Prices, spreads adjust faster than the credit rating, and ratings assess default risk, whereas spreads reflect expected loss. So we'll just finish this LOS with 2 quick practice questions. The first one, the fixed income portfolio manager you work with asks you why a bond from an issuer you cover didn't rise in price when it was upgraded by Fitch from B+ to BB. Which of the following is the most likely explanation? A, bond prices never react to ratings change. B, the bond doesn't trade often, so the price hasn't adjusted to the rating change yet. Or C, the market was expecting the rating change and so was already priced into the bond. C is correct. The market was anticipating the rating upgrade and had already priced it in. Bond prices often do react to rating change, particularly multi-notch ones. Even if bonds don't trade, their prices adjust based on dealer quotations given to bond pricing services. And one last practice question to finish this LOS. Amalgamated Corp and Widget Corp each have bonds outstanding with similar coupons and maturity dates. Both bonds are rated B2, B-, and B by Moody's, S&P, and Fitch respectively. The bonds, however, trade at very different prices. The amalgamated bond trades at 89 euros, whereas the Widget bond trades at 62 euros. What is the most likely explanation of the price and yield difference? A, Widget's credit ratings are lagging the market's assessment of the company's credit deterioration. B, the bonds have similar risks of default as reflected in the ratings, but the market believes the amalgamated bonds has a higher expected loss in the event of default. Or C, the bonds have similar risks of default as reflected in the ratings, but the market believes the Widget bond has a higher expected recovery rate in the event of default. That's a nice question to end on. A is correct. Widget's credit ratings are probably lagging behind the market's assessment of deteriorating creditworthiness. Answers B and C both state the situation backwards. If the market believed that the amalgamated bond had a higher expected loss given default, then the bond would be trading at a lower, not higher price. Similarly, if the market believed that the Widget bond had a higher expected recovery rate in the event of default, then that bond would be trading at a higher, not a lower price. And that's the last slide for this LOS. Thank you.